Hey everybody, Alf speaking. Welcome back to the Macro Compass. This is the very first edition of our Macro Data Screener video, a new video that is dedicated to breaking down all the macro data that were prevailing and important across jurisdiction, both growth and inflation, over the last few weeks. We're going to break them down regularly with you guys with the help of a chart deck. So let me share my screen with you guys so we can go through the important macro data that has been recently released. Let's start from growth in the US. And what happened there is that GDP for Q4 was released a couple of weeks ago. And one of the most important sub-indicator in the growth, in the GDP growth report in the US is called real final domestic sales. This is important because this series is much less volatile than government spending, net exports, net trades. It simply focuses on how much final domestic sales in real terms are done in the US, within the US. It gives you an idea of how strong domestic demand is, in other words. And as you already know, I like looking at data on a 3-month moving average basis. This allows us to smooth out noise from monthly or weekly prints and have a look at where the trend in macro is. So what you see here is this subcomponent of GDP growth called real final domestic sales. It tells us how strong really domestic demand is in the US. And we smooth it out by looking at the 3-month moving average. And in this case, we also annualize it. Here is where it's printing, 0.7% is the last data. So basically, you're looking at growth in the US coming down very rapidly from the reopening effect, the post-pandemic reopening, where this number was incredibly high. But even if you zoom away from the depression of the global lockdowns to the reopening euphoria, and you look at it against the long-term trend, you can see that domestic demand is pretty low. Today, it's at levels that are almost consistent with levels just before a recession starting. So this is an important point to understand where do we stand in the big picture when it comes to domestic growth in the US. The leading indicator index, let's move now to soft indicators. I mean, hard indicators like GDP growth are always backward looking. We talked about Q4. Let's have a look at what soft and leading indicators are telling us for US growth ahead. This is the updated print of the US Conference Board Leading Indicator Index. It's on a year-on-year basis, and what this indicator does is it basically puts together about 10 leading indicators in the US. It weights them and puts them into one index. And this is where it's printing. It's at pretty negative levels, consistent as well with pre-recessionary periods in the past. There has been a slight improvement on the way up. If you squint, you can see it here. It's basically trying to bottom out. And most of it, it's due, this attempt at bottoming out, it's actually due to consumer sentiment, which on a 3-month moving average basis, the University of Michigan consumer sentiment has shown quite the bottoming, as you can see here. Again, big picture still at pretty depressed levels, but we are attempting a cyclical bottoming out of these leading indicators. You can also see it somehow in the US leading indicator index, a bit more evident in consumer sentiment. And when it goes to PMIs, you really have still a split between the manufacturing cycle and the services cycle. So manufacturing is still pretty depressed. This is the new orders subcomponent of the manufacturing PMIs, the ISM. Again, 3-month moving average to smooth out the noise. And you can see we're printing at pretty depressed levels. No attempt almost at all to try to bottom out here. On the other hand, we keep printing pretty negative for the manufacturing industry. The services PMI new orders instead on a 3-month moving average, again, tried to have some signals of bottoming out. So if you take all the leading indicators, the big picture you get in the US right now is that we are attempting a cyclical bottoming out. But from a long-term big picture perspective, this is where we stand. Domestic final sales are pretty depressed in the US. The leading indicators is basically in recessionary territory. It's at the same level it was going into 2001 recession, for instance, or the 1990 recession. The consumer sentiment is also at levels that were consistent with the recession in the past, just before 2008, a great financial crisis. PMI new orders, the manufacturing industry is really depressed as well. Again, consistent with pre-recessionary periods. Services new orders are doing a bit better, but still on a long-term trend, they are below the long-term average. So what you are getting now is an attempt to reflect looser financial conditions that we have seen between November and January into some better sentiment in February, soft data. But on a big picture perspective, you still have both consumers and also the manufacturing sector in particular really feeling hurt from inflationary pressures and from real incomes going down. So from a growth perspective, this is basically the most important indicators we've got an update for over the last few weeks. What happened on an inflation perspective? So let's start in this case from soft indicators. Manufacturing prices paid. This is a subcomponent of the ISM manufacturing PMIs. Again, looked at it on a 3-month moving average perspective. And here again, the disinflationary process in manufacturing, which is reflected in goods prices, basically. This disinflationary process was very, very evident since the mid of last year until today. We are now trying to see some bottoming out in prices paid. The manufacturing prices paid subcomponent leads goods inflation by normally a couple of months, and we have already started to see some signs of used car prices, for instance, that are trying to rebound higher. Now, we are in a similar situation, therefore, where we are in a disinflationary cycle. We have started the disinflationary pressures, especially on goods. This disinflationary cycle is pretty advanced. But as per growth, we are attempting to find a bottom, a cyclical temporary bottom in this disinflationary process. It's evident in the prices paid index at the manufacturing level. When it comes to services, as you know, services inflation remains pretty elevated wherever you look at in the world. The disinflationary trend has somehow started. If you look at the absolute level of ISM services prices paid on a moving average basis, it's very high from an historical perspective, but the trend is also clearly on the way down. Now, basically, the services inflation side is what really matters for the Fed. So you need to see services inflation coming down pretty aggressively, this trend to be sustained on the way down. And when you move away from soft indicators to hard indicators of inflation, so core CPI and what Powell really likes to look at, which is CPI services ex-housing, the most sticky part of the inflationary basket, actually the fact that the soft indicators of services price paid are still at these high elevated levels doesn't give enough comfort yet to the Fed. And this has been reflected as well in the last CPI print, where you had two important things to consider. First one is that the revisions from 2022 made it so that, yes, core CPI on a trending basis has been moving down. This is 3 months annualized, again, in core CPI. So you can see how the trend is down, but pre-revision, the orange line, it seemed like the disinflationary trend in core CPI was actually pretty robust. After revisions, so that's the white line, the disinflationary trend is still there, which is also, again, evident in this services prices paid leading indicator, but it's not as steep as the Fed would like it to see. And also, if you look at CPI services ex-housing on a 3-month annualized basis, you're still running at about 5%. So we got further confirmation via revisions and via CPI services ex-housing 3-month annualized that the progress seen so far on services disinflation doesn't make the Fed yet comfortable with their inflation mandate. But if you look again at leading indicators, it seems like there is optimism to be had on the fact that, especially in the second half of the year, this disinflationary trend might continue. So the situation when it comes to growth and inflation in the US, looking at the macro data that we have had over the past 2 weeks, can be basically summarized as follows. We are in a negative impulse of growth period. We are there. It's evident, for instance, looking at hard data like real final domestic sales, this portion of GDP, it's trending at 0.7% annualized, which is a very low level. Leading indicators also printing at levels which are consistent with pre-recessionary periods. So that's late 2007, late 2000. We are at these levels. Within this big term trend, we have some attempt at bottoming out in consumer sentiment, in services new orders, for example. This seems to be mostly the reflection of looser financial conditions in November, December, and January into better sentiment and better data in February. Financial conditions, though, have tightened pretty aggressively since then, which probably means you should expect the long-term trend, which is for negative growth, to prevail going forward. The same story happens in inflation, where, for instance, in manufacturing prices paid, you can see some attempt for price pressures to restore themselves on a momentum basis on the way up. But again, if you look at services, the disinflationary trend has started. It's just that the momentum of this inflationary trend long-term is not yet strong enough, which is probably going to keep the Fed tight until they see these CPI services ex-housing starting to decline. So big picture, we are in a nominal growth disinflationary environment. The trend is there. It's probably not stopping, but we have had a temporary window, which might last another few weeks or a month, where you get temporary rebounds, both in real growth indicators and also in some inflationary indicators, which is what the market is getting very worried about, especially the bond market. Let's have a look at growth in Europe. So where do we stand from that perspective? So the Germany IFO Business Expectation Survey, it's a very good survey, the IFO. It basically looks at what is the business sentiment in Germany. And Germany is a very large manufacturing hub for Europe. So it's a very important indicator. Also here, we look at the 3-month moving average, and it printed at incredibly depressed levels in September, October last year, as we were looking into this energy crunch and even risks that almost the entire German industrial production and industrial sector should have been basically shut down because energy was too expensive. It printed at really depressed levels, even lower than the pandemic lockdown periods. It's now rebounding, which is to be expected. Europe actually did pretty well this winter when it comes to avoiding an energy crunch. But again, I invite you to look at where do we stand today, which is a rebound from depressed levels. But from an absolute perspective, we are not doing particularly well when it comes to business expectations from business owners. What about growth expectations? How is growth going to deliver in Europe? The answer is better than we feared, which was terrible, but not yet at levels consistent with strong growth ahead for Europe. This is also echoed by a hard data, which is Germany real retail sales. So you have to be careful with retail sales because in most cases, they are delivered as a nominal number. So if prices are going up and you're buying exactly the same stuff as before, it looks like nominal retail sales are going up. The reality is the best way to look at retail sales is in inflation-adjusted numbers, real retail sales, because that really tells you about the real spending power, the real growth prospects for the economy. So I decided to plot for you guys both the index of German real retail sales, that's the blue one. You can see over time it goes up, right? I mean, real economic growth is positive over time, but there are cycles. So I decided also to plot the drawdown for real retail sales from their peak when it draws down in a cycle of negative growth cycle. So you can see 2009, this is the great financial crisis, 2013, post the European debt crisis, and today. And these drawdowns are generally, about 5% from their peak. Peak to trough drawdown in real retail sales during recessionary periods are roughly 5%, 4 to 5%. Well, today, real retail sales in Germany have already drawn down 5% from their peak, and it doesn't look particularly well for real spending for consumers in Europe. So again, here you have a situation where soft data is showing some tentative attempts at bottoming out, and it makes sense given the energy crunch has been mostly avoided. But from a structural perspective, European consumers don't look to be doing particularly well. Finally, let's talk about Asia. China. So the composite PMIs in China, both the Caixin and the non-Caixin version, which I decided to show here, are looking particularly good. So the reopening finally is feeding into data. And here the story is that China had always reopened. The issue is that market so far has been pretty schizophrenic. So they're really looking for short-term confirmation of any new narrative, being disinflation, and now it's higher for longer. So markets are very impatient. They lack conviction. But actually, the Chinese composite PMIs show the Chinese reopening is morphing into more positive data. I expect this to continue for another couple of months. There will be a point when the Chinese growth will be well incorporated into data, into service, and into expectations. We are moving there, but not there yet. So expect more positive data coming from China. What about inflation, both in Europe and in Japan? We discussed about growth in the US, growth in Europe, growth in China. Inflation in the US, what we miss in the global macro picture is inflation in Europe and in Japan, exactly in the two places where you wouldn't expect inflationary pressures to show up. Instead, you have inflation printing higher and higher. What you see in this chart is European services inflation year over year, again, on a 3-month moving average perspective. The chart, I guess, basically speaks by itself. Services inflation is picking up. It's very, very high. And the momentum of this series is picking up as well. So that's definitely not good news for the European Central Bank, which probably will have to tighten policy further. And finally, inflation in Japan. This is Tokyo, core inflation year on year, 3-month moving average. It's basically a great leading indicator for nationwide core inflation in Japan. And also in Japan, you now have core inflation on a momentum basis, annualized, running at about 3%. Wage negotiations are coming. These rounds will be very important to set monetary policy for the path ahead for the Bank of Japan. I think these numbers are starting to become clearer and clearer that also in Japan, also in Europe, inflation is becoming a problem. It's becoming stickier, more broad-based. So I would expect also the Bank of Japan to take action on inflation and join the bandwagon of other central banks that have acted earlier. So you will have now also Europe and Japan more convincingly so on the hiking path. So summarizing this video, what we have had over the last 2 weeks is further confirmation that a temporary attempt for growth to rebound, which is visible in consumer sentiment or it's visible in PMI new orders, you're having a temporary attempt of a rebound in cyclical growth, but you have that within the big picture of real growth slowing down. That hasn't changed. That big picture remains in place. You have a temporary window for some cyclical growth attempt at bottoming. The same you have for inflation, where, especially on the manufacturing side, it looks like there is some attempt for manufacturing prices to rebound, but this is happening while we should remain in a disinflationary trend, which should become more evident in the second half. But because of these temporary elements of better real growth and better inflationary prospects, stronger inflationary prospects, central banks might actually be forced to tighten the belt even further, despite we should already be in a nominal growth slowdown. Over time, the fact that central banks will be even tighter now, despite the long-term trend being already pretty negative on nominal growth, should reinforce recessionary pressures. The data coming in has maybe delayed a bit my call for a recession in the US. It used to be about May, if you remember my median starting date. Perhaps it's going to be June or July, but the evidence, it's probably becoming even stronger because central banks now are likely to react even more aggressive and be even tighter than expected for another few months, trying to react and to show strength and more hawkish stance against this very cyclical, short-lived rebound in real growth and in inflation. That's where we stand today. And I hope you guys have enjoyed this video. You will receive as well the chart deck. You should have received as well the chart deck in an email. And I wish you a very nice rest of the day or rest of the week. And we'll talk again soon here on the Macro Compass.